SoFi Technologies Inc., listed on the NASDAQ under the ticker SOFI, is currently on a scheduled pause. As of today, Monday, January 19, 2026, the United States stock markets are closed in observance of Martin Luther King Jr. Day. The final price recorded at the close of the last trading session on Friday, January 16, 2026, was 26.13 USD. This marked a slight intraday pullback of 0.31 USD, or 1.17%. In the after-hours session, the stock experienced a minor further tick downward, settling at 26.10 USD, a drop of about 0.018%. If you're looking at that $26 handle and thinking SoFi is just another fintech company struggling with high interest rates, you're missing the massive tectonic shift happening under the surface. Here's the reality that most of the retail crowd has not caught on to yet. SoFi is no longer just a lender, it's becoming a critical infrastructure provider for the entire banking industry. While everyone was focused on their student loan refinancing numbers, SoFi has been quietly signing deals with major consumer brands like Southwest Airlines and Wyndham Hotels to power their entire financial back-ends through the Galileo and Technisys platforms. This is not just about making loans anymore, it's about collecting a toll on every transaction made by millions of people who might not even know they're using SoFi technology. This pivot into the AWS of Fintech is the real driver behind the stock's 465% climb over the last 3 years, and it's why the current hold rating from many analysts feels like they're looking in the rearview mirror while the company is flooring it toward a completely different destination. The general expectation for SoFi stock throughout 2025 was that it would eventually hit a ceiling as the Henry target demographic, high earners not rich yet, maxed out their borrowing capacity. The market narrative was that once student loan interest rates stabilized, SoFi would lose its competitive edge. However, the reality has completely shattered that belief. By the end of 2025, SoFi achieved something its skeptics said was impossible: 8 consecutive quarters of GAAP profitability, ending the year with an estimated trailing 12-month net income of approximately $600 million. This is a massive leap from the days when the company was burning cash just to acquire a single new member. If you're managing your own online investment through a Fidelity brokerage or checking your Robinhood app every morning, you've likely seen the volatility. But that volatility masks a fundamental transformation from a speculative growth play into a high-margin profit engine. Looking at the recent market movement, the trading volume on Friday was about 40.4 million shares. That sounds like a lot, but it's actually about 27% lower than the daily average of 55 million shares. This suggests that the big institutional players at firms like BlackRock or those managing Schwab Intelligent Portfolios are sitting on their hands, waiting for the Q4 and full year 2025 earnings report scheduled for January 30th, 2026. The stock is currently sitting in a bit of a no-man's land between its 50-day moving average of 27.51 and its 200-day moving average of 25.94. This tightness in the price action usually precedes a massive breakout or a sharp correction. Given that the consensus price target is hovering around $25.50, the stock is actually trading slightly above what many traditional analysts think it's worth. But those analysts are often slow to price in the exponential growth of the technology platform segment, which saw revenue jump by 12% in the last reported quarter, despite a slight decline in total enabled accounts. Institutional activity has been a mixed bag lately. We saw some significant selling from insiders, about 167,000 shares worth over $4 million in the last 90 days. For someone self-investing, that might look like a red flag. However, when you dig into the filings, you see that institutional ownership is still sitting around 38.4%, with massive new positions being taken by heavyweights like Norges Bank and Sumitomo Trust Bank. These are not quick flip traders. These are sovereign wealth funds and global asset managers who are betting on SoFi's long-term inclusion in the S&P 500, which many believe could happen as early as the first quarter of this year. The expectation of S&P 500 inclusion is a powerful catalyst that often forces institutional buying, creating a floor for the stock price that retail investors on platforms like SoFi Invest or the Interactive Brokers platform can lean on. What exactly does SoFi do today that justifies a $31 billion market cap? It operates three distinct business lines that feed into what CEO Anthony Noto calls the financial services productivity loop. First, you have the lending business. This is the traditional side: student loans, personal loans, and mortgages. Because SoFi has a national bank charter, they can use their own member deposits to fund these loans, which gives them a significantly higher profit margin than a company that has to borrow money from other banks to lend it out. Second, there is the financial services segment. This is the consumer-facing app where you can trade Tesla stock or Nvidia stock, manage your SoFi Money account, or get investment help. This segment turned profitable in 2024 and is now a major contributor to the bottom line. Third, and most importantly, is the technology platform. By owning Galileo and Technisys, SoFi provides the digital pipes for other fintechs and banks. They're essentially selling the tools to their own competitors, which is a brilliant way to diversify revenue and reduce sensitivity to interest rate swings. The tension between expectation and reality is especially high right now because of the upcoming earnings call on January 30th, 2026. The market expects earnings per share of about 11 cents for the quarter. If SoFi beats that, which they have done for 13 straight quarters, we could see a rapid move back toward the 52-week high of 32.73. However, if they give a conservative outlook for 2026, the hold crowd might start to take profits. This is the risk of online investing in a high-beta stock. The market is looking for perfection, but the reality of the business model is that even if loan originations slow down, the fee-based revenue from the tech platform and the net interest income from their massive deposit base provide a safety net that traditional banks simply don't have. I want to pause here and get your thoughts. Comment below with how many shares of SoFi stock you are currently holding in your individual brokerage account. Do you think the potential S&P 500 inclusion is already priced in, or are we about to see a massive institutional wave push this stock into the 30s? Sharing your perspective helps everyone in this community get a better sense of the retail sentiment that often drives these fintech swings. When you look at the macro picture, SoFi is positioned to benefit from what some are calling a neutral interest rate environment. If the Fed keeps rates between 3.5% and 3.75% throughout 2026, it creates a Goldilocks scenario for SoFi. Rates are high enough that they can earn a decent spread on their deposits, but low enough that people are still willing to take out personal loans and refinance their homes. This is why you see so much activity on investing sites and from people seeking investment help. They're trying to find the point where the cost of borrowing and the reward for saving balance out. SoFi, with its high-yield savings accounts and integrated investing platform, is the primary beneficiary of this balance. If you're using SoFi Active Investing or even a SoFi Robo-Advisor, you're part of the ecosystem that is driving this lower customer acquisition cost that Wall Street is finally starting to appreciate. The historical context of the stock is also important for perspective. Remember, after its SPAC debut in 2021, SoFi crashed to under $5 during the fintech winter of 2022. There were plenty of people who thought the company would go bust, but the acquisition of the bank charter was the turning point. It transformed them from a middleman to a destination. Today, with a debt-to-equity ratio of just 0.31 and a net margin of nearly 20%, the company is on much firmer footing than it was 3 years ago. If you're using the Interactive Brokers trading platform or Fidelity mobile app to track your portfolio, you can see that SoFi's beta of 2.92 makes it nearly twice as volatile as the broader market. That means when the market is up, SoFi flies, but when the market corrects, SoFi can drop painfully fast. This is why having a clear plan for your individual brokerage or Fidelity IRAs is so important. You can't trade a stock like this on emotion. Looking forward to the rest of 2026, there are a few key catalysts to watch. First is the aforementioned S&P 500 inclusion. Second is the expansion of the technology platform into international markets, particularly in Latin America through partnerships with banks like Mercantil Banco. Third is the potential for SoFi to re-enter the cryptocurrency space with more robust offerings, including stablecoins and blockchain-based remittances. Management has been hinting at these new verticals for months. If they can successfully integrate these without drawing the ire of regulators, it adds another layer of high-margin revenue to the pile. The expectation is that 2026 will be a year of steady growth, but the reality might be another year of explosive growth as the productivity loop really starts to spin. For those of you using Schwab Intelligent Portfolios or Fidelity Wealth Management, you might notice that fintech is often a small slice